Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at IREN.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, absolutely.
And before we get into it, just a quick reminder, you can check out the StockOracle 14-day trial link right down in the description. We do have a quick affiliate disclosure for that. You know, we get a small commission if you sign up through that link.
Right.
And please remember that AI insights and value estimates, well, they can be wrong. So always, verify on your own.
Always verify.
Exactly. And just to put it out there, none of this is financial advice. We're not telling you to buy or sell or hold anything today. We are just looking at the research, focusing on long-term wealth building, and trying to figure out if this company can actually compound shareholder value over time.
Yeah, protecting capital while looking for those durable growth drivers.
Right. So, okay, let's get into IREN. I want you to imagine you're on a commercial flight. You're 30,000 feet up in the air, right? And the pilot comes on the intercom and announces that they are going to swap out the jet engines. Not when you land, like right now, while you're still in the sky.
That is a completely terrifying visual.
Right. But in the corporate world, in the financial world, that is basically the exact level of operational risk and, sheer audacity that we are looking at with our source material today.
Yeah, it really is a high-stakes transition.
It's massive. So IR is attempting this mid-air engine swap. Their entire goal is to pivot completely away from being a pure-play Bitcoin miner and transform into an AI cloud infrastructure provider. And as we look at the research, it's just this absolute financial mystery. Because on paper, the business milestones look monumental.
They do.
They are sitting on a massive $2.8 billion backlog in AI cloud contracts right now.
Yep.
And they recently raised their annualized run rate revenue target, their AR, to over $4 billion.
Which is just staggering growth. Assuming they can actually, execute and cross the finish line.
Right, assuming execution. But here is the massive disconnect. This is the mystery we have to solve today. Despite those incredible operational updates and, billions in this contracted backlog, the stock is just getting hammered.
Yeah, it's rough out there for them.
It's down roughly 48% from its 52-week high. It's trading around $39.58. But maybe the craziest part to me from a capital protection standpoint is the short interest.
Oh, yeah.
It's sitting at 26%.
That's huge.
Yeah, 26% of the float is investors actively betting against the company. So our mission today is to figure out why the market is pricing in so much severe skepticism.
Right.
And what this case study tells us about the realities of pivoting a business in the, digital infrastructure space.
Well, IREN really is the perfect lens for this because they represent a much broader market rotation.
Yeah.
We are seeing this historic shift of capital into digital infrastructure.
Right.
And it's being driven almost entirely by this insatiable demand from hyperscalers for GPU compute power. Like, the fundamental landscape of how computing happens is just completely changing.
Yeah, it's all AI now.
Exactly. And IREN is trying to position itself right in the center of that wave. But the broader market, they're not just going to hand them a premium valuation based on, well-written press release.
Right, definitely not.
Investors are demanding proof that the new engine actually works under load.
So what does that new engine actually look like? The research report talks about their transition from crypto mining to what the industry is calling the neocloud.
The neocloud, yeah.
Which is a cool term. But for anyone who hasn't been tracking this, IREN isn't just throwing the word AI onto a slide deck.
No, they've hit some real milestones.
Yeah, they just completed their first Microsoft AI cloud deployment down in Texas.
Which they're calling Horizon 1.
Right, Horizon 1. And they also earned this NVIDIA exemplar cloud status. Plus, they've secured massive contracts with major AI players like Figure AI and FluidStack.
Yeah.
And there's this broader sector tailwind too, right? Like, we're seeing the launch of a new neocloud ETF that targets companies renting out this AI compute space.
Yeah, and that concept of the neocloud is so crucial to understand if we're looking at long-term wealth building here. Because when we think of traditional cloud, we think of the big three, right? Amazon AWS, Google Cloud, Microsoft Azure.
Right, the usual suspects.
Exactly. But the neocloud is this emerging layer of specialized high-performance infrastructure providers. These are data centers built specifically from the ground up for the intense power and liquid cooling demands of AI workloads.
Because it's way hotter, right?
Oh, yeah. It's far more demanding than traditional enterprise cloud hosting.
But that brings up a critical question for me looking at the fundamentals. It sounds great to get a stamp of approval from Microsoft and NVIDIA, but I mean, I have to be a bit cautious here.
Sure.
Isn't exemplar just kind of a marketing term? I mean, every single former crypto miner out there claims they're pivoting to AI to catch the hype cycle.
That's true. They all do.
So does this third-party validation actually separate IREN from the rest of the pack, or is it just industry buzzwords? Like, is there a real competitive moat here?
It actually separates them materially because the engineering demands of the two fields are just worlds apart. I mean, Bitcoin mining requires a ton of raw electricity, sure, but it's a very simple computing process.
Right.
It's highly fault tolerant. If a row of Bitcoin miners loses power for 10 minutes, it's annoying, but it's not a disaster.
You just miss out on a little bit of crypto.
Exactly. But AI cloud infrastructure, especially for a tier 1 hyperscaler like Microsoft, requires the exact opposite. It demands massive, uninterrupted data throughput, specialized fiber optic networking like InfiniBand, extreme redundancy, and virtually zero downtime.
Because the training runs are so expensive.
Right. An AI training run can cost millions of dollars. If the data center blips, that run can be ruined. So achieving NVIDIA exemplar status and getting Microsoft to physically put servers on your site,
It's a big deal.
it proves to the market that your concrete, your steel, and your power architecture can actually handle mission-critical workloads. It theoretically removes a huge chunk of that perceived execution risk.
Okay, I hear you on the technical validation, and they have that $2.8 billion backlog. But the math on their financials, it just feels completely broken to me.
Well, this is where we see the reality behind that 48% drop.
Yeah, because the balance sheet in the report is full of contradictions. Like, okay, for the 9 months ending March 2026, their trailing revenue was almost $570 million.
Which is an 82% increase year over year.
Incredible growth, right?
Yeah.
And their operating cash flow doubled to nearly $290 million. And maybe most impressively, they're sitting on a cash war chest of $2.2 billion.
Which is huge. On the surface, you look at those fundamentals and assume they have a fortress balance sheet, right?
Right. You'd think they could weather any storm.
Yeah.
But then you look at the liabilities, and this is where my capital protection alarms start going off. The quarterly trends are deteriorating super fast. In just their third quarter, they posted a net loss of almost $248 million.
Yeah, that's a tough quarter.
But more shockingly, their total liabilities have quadrupled, going from $1.1 billion up to $4.6 billion.
A massive jump.
Which leads to the ugliest metric in the entire report. They have a mechanical free cash flow proxy of negative $1.38 billion.
Yeah.
Because they have an immense $1.66 billion in capital expenditures, their CapEx.
Right.
So wait, help me out here. The math isn't adding up. If they have $2.2 billion in cash, why are their liabilities exploding to $4.6 billion? Where is all that debt coming from?
Because they are trapped in what analysts call a heavy build phase.
Okay.
That $2.2 billion in cash sounds like a massive safety net. But in the world of Tier 1 AI infrastructure, it's kind of just a drop in the bucket.
Really, $2 billion is a drop in the bucket.
When you think about what it takes to fulfill a $2.8 billion contract backlog, yeah, before you can send the client a single invoice, you have to build the physical reality.
Right, the actual buildings.
Yeah, you're buying high-voltage electrical substations, industrial liquid cooling systems, reinforced concrete floors, because, you know, GPU server racks weigh thousands of pounds.
Wow.
And you have to buy the chips themselves. You have to pay for all of that today, but you only recognize the revenue from those contracts trickling in over the next 5 to 7 years. So you have this massive immediate outflow of capital, that $1.6 billion in CapEx, happening long before the cash register rings. So they're funding this expansion through debt and escalating liabilities, and they're doing it in a race against the clock.
That brings the mid-air engine swap analogy perfectly into focus. You're buying this wildly expensive new engine, paying the mechanics to install it, fueling it up, and you're just praying the passengers actually buy tickets for the next leg of the flight.
Exactly. And this is where the operating cash flow metric becomes really deceptive.
How so?
Well, if we look at their long-term growth drivers, right? Let's break down the engines. Their existing engine is that legacy crypto mining business.
Which they're trying to phase out.
Right. But right now, it's positive. It's generating that $290 million in cash flow. But that doesn't even come close to covering the $1.6 billion they're burning to build the emerging engine, the new AI infrastructure.
Yeah, 290 million against 1.6 billion that's a huge gap.
Right, and that massive gap is why their free cash flow is negative 1.38 billion. It is a terrifying race against time, rising debt, and frankly, the fragile patience of the stock market.
Yeah, and speaking of the market's patience, looking at the technicals and the sentiment check here, it seems like patience has completely run out.
Oh, it really has.
Because when we map this fundamental race against time onto the stock charts, the technical setup is flashing some severe warning signs.
Yeah, it's not pretty.
The stock is trading below all its major moving averages. The 20-day, the 50-day, the 200-day. The research specifically highlights a death cross.
Right, which is when the 50-day crosses below the 200-day moving average.
Exactly. And on top of the charts breaking down, the valuation and expectations are just priced for absolute perfection.
Yeah, they are.
The PE ratio, the price to earnings, is an astronomical 207.
Wow.
And the price to sales ratio is over 21, plus a beta of 4.33, meaning this stock is more than 4 times as volatile as the broader market.
It's incredibly volatile.
So how can a company with 82% revenue growth and a Microsoft partnership trigger every single technical warning sign an algorithm has?
Because financial markets are forward-looking mechanisms, right? And right now, the market is terrified of the execution gap.
The execution gap?
Yeah, those technical indicators like the death cross, they signal to algorithmic traders and momentum funds that the upward trend is broken, which triggers automated selling. But the root cause is that market sentiment is lagging way behind the operational press releases. When investors see a PE ratio of 207, they're being asked to pay today for profits that won't materialize for years.
Right, they want to see the money now.
Exactly. The market looks at the quadruple liabilities, the deeply negative free cash flow, and just the sheer physical complexity of building data centers, and it decides to sell now and ask questions later. They want to see the new AI engine functioning and generating cash before they pay a premium.
Which brings us to, honestly, what could go wrong. The biggest threat to long-term wealth building here, the immediate threat of dilution.
Yes, the dilution is the scary part.
It's the most precarious part of this entire report for current shareholders. So let's look at the catalyst roadmap. In the near term, we have this looming fourth quarter projection that is just brutal to read.
Yeah, it is.
Analysts expect a 30% year-over-year revenue decline, dropping down to about $130 million, alongside a net loss of 55 cents per share. This is what the analysts call the revenue gap.
Right, the revenue gap. It's that exact moment in our mid-air swap where the old crypto engine is completely turned off to save power, but the new AI engine hasn't fully spooled up yet.
So the plane is essentially in free fall for a quarter.
Basically, yeah.
And the critical near-term catalyst for whether they pull out of that free fall is their August 27th earnings report.
Which is huge.
That's massive. And then looking medium term, their stated corporate goal is to reach 480 megawatts of power capacity by the end of 2026.
Right.
Which involves deploying what they call Horizons 2 through 4. But to fund that massive build-out, they've put a $6 billion ATM offering in place, an at-the-market offering.
Yep, $6 billion.
And I always think of an ATM offering kind of like a pizza, right?
Guy pizza.
If you slice a pizza into 100 thin slices instead of 8 regular slices, you still have the exact same amount of total food.
Right.
But everyone's individual piece just got way, way smaller.
Yeah.
But how does an ATM actually work mechanically on the open markets? Like, is this $6 billion offering the real reason we're seeing 26% of the float sold short?
Oh, absolutely. The ATM offering is the primary blood in the water for short sellers.
Really?
Yeah. Mechanically, an at-the-market offering allows a company to issue brand new shares and sell them directly into the open market at whatever the current trading price happens to be.
Okay.
It's very different from a traditional secondary offering where a set price is negotiated ahead of time. So if IREN is forced to tap heavily into that $6 billion facility, while their stock price is currently depressed by 48%.
Oh, I see where this is going.
Yeah, the dilution for existing shareholders becomes this vicious, self-feeding downward spiral.
So let me make sure I follow the mechanics of that spiral, because capital protection is key here. A short seller pushes the price down by betting against the stock.
Right.
Because the price is lower, IREN now has to issue and sell a much higher number of new shares just to raise the exact same amount of cash they need for concrete and steel.
Exactly.
Which dilutes the pool even faster, driving the price down more.
That is the exact loop. You're constantly issuing more shares at cheaper prices to fund the same fixed construction costs.
Wow, that's dangerous.
It is. The short sellers who make up that 26% are actively betting that IREN's massive negative free cash flow will force management to hit that ATM button.
Right, dumping shares.
Yes, dumping shares and driving the price down further, ensuring the short sellers profit.
But wait, doesn't a 26% short interest create a massive asymmetrical risk for the short sellers themselves? Like, what happens if they're wrong?
Oh, it creates explosive risk for them.
Really?
Yeah. If the upcoming earnings report beats expectations, like if management proves that the AI cloud revenue is scaling faster than anticipated, or maybe they announce alternative financing so they don't have to touch the ATM.
Okay, then what?
Then that 26% short interest suddenly turns into rocket fuel.
Because they have to buy it back.
Yes, exactly. When positive news breaks, short sellers are legally obligated to buy the stock back on the open market to cover and close their borrowed positions. When that many people try to buy a rising stock all at once, it triggers a massive short squeeze.
Wow.
It sends the price skyrocketing in a matter of hours. So you have this incredibly binary setup here. It's either a dilutive death spiral or a violent short squeeze, and it all hinges on management's ability to execute.
Okay, so assuming they don't crush the plane, right,
Yeah.
and they navigate this upcoming quarter, the research report does outline a 3 to 5 year blue sky scenario.
Yeah, the long-term view.
And they explicitly state this is a conditional optimistic scenario. It is not a guaranteed prediction.
Right, definitely not a predictor.
But it maps out what the company looks like if the mid-air engine swap is actually successful, and the optionality here is huge.
It completely changes the fundamental nature of the business.
It really does, because the conditions are straightforward but difficult. They have to deliver horizons 2 through 4 on a strict schedule, hitting that 480 megawatt goal.
Right.
And they have to smoothly convert that $2.8 billion backlog into recognized recurring cash flow.
Yes.
If they do that, operating leverage finally kicks in. The heavy upfront CapEx spending tapers off because the buildings are finished, right?
Heavy build phase ends.
Exactly. And all that new AI subscription revenue falls straight to the bottom line, shifting their free cash flow from deeply negative to highly positive. If they pull this off, they shed the identity of a highly volatile crypto miner.
And they transform into a stable, pure-play, digital infrastructure giant.
Which is the dream.
It is. The ultimate financial reward for IREN here isn't just higher revenue. It's something called a multiple re-rating. That's the long-term catalyst.
Multiple re-rating. What does that actually mean for the stock?
Well, right now, Wall Street evaluates them with this hybrid of deep skepticism applied to crypto stocks and the panic applied to companies burning cash.
Right. Hence the PE of 207.
Exactly. But if they successfully cross the chasm and become a pure AI cloud provider with multi-year recurring revenue contracts.
Like a utility almost.
Exactly. Wall Street will entirely change how it categorizes them. They'll be valued much more like a high-end tech utility or maybe a specialized data center real estate investment trust.
Oh, I see.
Yeah, those types of established infrastructure companies, they trade at incredibly stable premium valuation multiples because their cash flows are locked in for a decade.
Right.
That multiple re-rating is the promised land that IREN is burning $1.6 billion to reach.
Okay, so we have the terrifying dilutive revenue gap on one side of the equation, and the promised land of becoming a premium tech utility on the other. That brings us to our wealth-building verdict from the source material.
Let's do it.
So the analysts give IREN an overall rating of a 5, which represents a firm, neutral stance.
Which makes sense.
It does. They anchor on the base case. This is a high-risk, high-reward transition. The opportunity is remarkably real. I mean, you simply cannot fake a $2.8 billion backlog or a physical data center deployment with Microsoft.
No, you can't fake that.
But the execution and financial risks required to get there are immense. The $4.6 billion in liabilities and the negative cash flow are heavy anchors weighing down the current valuation.
Yeah, they really are.
If you're hearing these numbers and thinking, you know, this sounds incredibly complex and risky, you aren't alone. It validates just how difficult it is to analyze, let alone invest in, a company that is right in the middle of a fundamental identity crisis.
It really forces anyone looking at the market to think critically about the gap between narrative and reality.
Right.
Because the broader market loves the narrative of artificial intelligence. It's a great story. But it deeply hates the messy, expensive, delayed reality of actually building the physical infrastructure required to make it work.
It's so true.
The neutral rating from the report makes perfect sense because the binary outcome, the short squeeze versus the dilutive ATM spiral, is entirely dependent on management's physical execution over the next 2 to 3 quarters.
It all comes down to keeping the plane in the air while the mechanics turn the wrenches.
Yeah.
So as we wrap up this deep dive into the source material, there is one final broader thought that really sticks out to me from all these financial metrics.
What's that?
Well, as the entire tech world rushes to build out AI capabilities, almost all of the mainstream media attention is totally focused on the software.
Oh, for sure. Chatbots and models.
Right. We hear endlessly about the large language models, the generative chatbots, the crazy AI startup valuations. But based on the sheer scale of IREN's capital expenditures, I mean, burning over $1.6 billion just to get the initial phases powered up, it's a ton of money.
It is. We have to ask a much larger macroeconomic question here. Is the real strongest long-term driver and bottleneck to the AI revolution going to be writing better software code?
Or is it going to be the physical constraints?
Exactly. The staggering physical constraints of the real world, the reinforced concrete, the specialized steel, the high-voltage transformers, and just the sheer time required to build the massive structures needed to run it.
Yeah, the physical constraints of our electrical grids and supply chains might end up dictating the ultimate speed of our digital future.
And that is definitely something to mull over the next time you casually ask an AI to summarize a book or write a poem. It takes a massive amount of concrete, steel, and debt just to generate those words.
It really does.
Thanks for joining us on this analysis. And before we go, remember to check out the StockOracle 14-day trial link in the description to help with your own research. Just remember those AI estimates can be wrong, so always double check the numbers.
Definitely. See you next time.